Hey guys, good morning. If you could just give me a quick sound check, that would be wonderful, and let me know if you're hearing me loud and clear. If you need me to adjust the volume in any way, it would be helpful if you let me know. But I think I'm hoping anyway the volume should be fine because we use Omnovia quite a bit. Well, hope you guys are having a good day. The markets the last couple of days choppy, huh, guys? It's been a very interesting last couple days. I like to trade. And I'll talk a little bit about that here today. Um, I'm typically done trading by this time of the day, and today was not a super active morning. Not a whole lot out there, but there were a few good ones. But I've been noticing the last couple days that a lot of the extended novice stuff, the stuff that's extended long, has been continuing to go higher with the market. If you guys have noticed, the spiders and the Qs have been going higher quite a bit the last 8 or 9 or 10 days. But before I get into any of that stuff, um, let me introduce myself. My name is Jared Wesley. I've been trading equities, which is the only thing that I trade. I do not trade futures. I don't trade Forex. I trade specifically and only stocks. And I am predominantly a short-term trader. I like to take, 5 to 10 trades a day, some days 15 to 20, but that would be a heavy day for me. And I'm not necessarily shooting for huge targets. I like to get just small, quick targets, if you will, scalping, so to speak, and move on more into the frequency aspect of trading. I've been here at Pristine for about 8 years. It's where I cut my teeth. I spent a little bit of time at an institutional trading desk when I was younger out of college, and I can tell you guys that for those of you that have done both, technical analysis trading is far different than what people think of Wall Street. Um, a lot of people have that chip on their shoulder. Oh, I work on Wall Street. But what they do a lot of the times is mainly order taking. Now, don't get me wrong. There's some great traders on Wall Street. But I think you'll find far better traders here at TradingPub with a lot of the presenters that you'll see here today. So today I wanted to talk a little bit about warning signs that might keep you out of losing trades, right? There's a lot of what I would call nuance to trading. A lot of people like to say, all right, here's a textbook, go learn it, and as soon as you learn the textbook, you're good to go, right? I mean, you're just going to go out there in the marketplace and you're going to kick butt and take names. But, well, that's just not the truth, right? I mean, you need a foundation, so you do need an education, but you need market experience, right? And without that market experience, you're kind of dead in the water, So one of the things we try to do at Pristine, and in fact today I believe we have an open house in one of our chat rooms, is kind of combine the textbook with reality, right? The real markets, showing traders how to take a trade or what those trades look like in real time, et cetera, and so forth. So I wanted to talk a little bit about that today, but I wanted to just focus on how to keep you guys out of bad trades. Okay. Before I do that, there's a disclaimer that we have to cover, guys. And I always like to go over this. A lot of people don't like to go over these disclaimers, but for me, it's important because I want people to respect the market. There's a lot of people that come in, they open up an E-Trade account and they think, oh, well, market can't be that hard, right? It's just a stock market, and they don't respect the market and they don't realize that, yes, it's possible that you could lose significant amounts of money if you're not smart with your money. And I'm going to talk a little bit about that later, about, perhaps how much you should be risking or how much you shouldn't be risking. So just understand that the markets are incredibly risky. And if you're not smart, if you don't have good money management, if you don't have a good education, you're not likely to get very far. All right. And I know you roll your eyes and go, yeah, but it's the truth. You guys have all seen and heard the stories of traders that lose hundreds of thousands, some people even millions, et cetera, and so forth. So it is important to take this topic seriously, even if you want to roll it off. But it really is one of the most important parts of trading. We used to have somebody that worked for Pristine years ago that would say, it's a shame about most traders. By the time they actually learn how to trade, they don't have any money left. Isn't that the truth? By the time they actually learn what it is they're doing, the market's taking all their money. They could have learned those same lessons without spending as much money. So you have to respect the markets. For those of you who don't know Pristine, we've been around a long time. In fact, I think this year, towards the end of the year, is going to be about 20 years for us. Through that time, we've helped a lot of traders, whether they be novice traders, professional traders, et cetera, and so forth. And we actually recently won best trading course for last year and the year before, and I think we won a few other best trading room for last year. We won a whole slew of stuff for last year at Trader Planet. So we're pretty proud of that. We've been written up a lot. The reason I bring up these things and everybody pitches their companies and do what they do is we've been around longer than anybody that I'm aware of. So I don't know of any other company or in educational trading company that's been around longer than Pristine. So to us, we're proud of that. And we've been doing this a while, so we know what we're doing. But let's dig in, guys. Let's dig in. So over the next 45 minutes, next hour or so, I want to talk about these two warning signs. Okay, 1, multiple time frame analysis, and 2, volume analysis. I'm going to talk about a couple other things that I'll kind of throw in there in the middle as I go through this. But one of the big things that traders misunderstand is how to look at different time frames. A lot of traders, and I was guilty of this when I started, they like to trade in what I call a vacuum. Oh my gosh, did you just see that perfect 2-minute chart or that perfect 5-minute chart? And they have no concept that that 2-minute chart is only valid or viable because of a higher time frame, right? So we have to start with that higher time frame bias and then move down. We call it a top-down approach, all right? And it's a very important part of trading. And if we miss it, you're likely going to struggle, okay? And then we're going to talk a little bit about volume analysis. There's different types of volume out there. And to me, we always talk here at Pristine that price is number one and it's the most important thing you need. And that is true. But to me, volume is right up there with price. It's almost 1A and 1B for me when it comes to trying to stay out of bad trades. Volume plays a significant role in whether or not a trade is going to work or not. Okay, so we'll talk about what to look for during and after the entry. All right. So what do we mean by multiple time frames? Well, when we can get everything in alignment, right? If you can get a higher time frame like a weekly chart or a monthly chart or a daily chart, it depends what style of trader you are. But when you can get these charts in alignment with the higher time frame and the lower time frame, a higher chance of success, right? Because when you think about it, the big money, right, the longer term money is in the higher time frames, the dailies, the weeklies, the monthly charts. So if you can just ride the wave and then enter those waves on smaller time frames like a 2-minute or a 5-minute, you're going to have a far better chance of succeeding, okay? So here at Pristine, we teach different trends or different stages, right? You have your uptrends, your downtrends, your sideways trends, but within those trends you have, a stage 1 sideways trend, but you also have a stage 3 sideways trends, and they go sideways completely differently. And we don't have time today to get into the details of how they go sideways differently, but you have to understand that there are a lot of differences in how the market moves. And the average person's getting in late and getting out late, meaning they're buying high and they're selling really, really low, right? A good trader will buy low or even buy a little high, but they get out when they see a transition, when they see things changing, okay? So why do we want to look at the markets in different time frames? Right? Why do we want to view supply and demand or support and resistance in different time frames? Well, it's a lot more important than you might give it credit for, right? So you want to look at multiple time frames, one, just to give you the clearest view possible. Right? Think about this for a second, guys. If you are in a forest, all right, a lot of traders do what I say, what I call looking at the leaves and the bark and the branches of a tree, right? They look at the leaves, they look at the bark, they look at the branches, and they get caught up in that stuff, right? They get caught up in those things. And they don't understand that there could be a fire, a little ways down the road, and they're not seeing it because they're so caught up examining the leaf that they don't realize that, hey, wait a second, maybe the whole forest is on fire, okay? So that's an area that for a new trader, it's not even something they consider, right? It's not even something they generally consider. Now, for an experienced trader, they won't take a trade without it, right? They won't take a trade without looking at those things, okay? Now, and you guys might have to excuse me just for a second here or there. I'm in a one position at the moment, and I'm just trying to adjust a couple things. So we like to look at multiple time frames as if you were in a helicopter hovering above the forest going, okay, this is what the big picture looks like. But guess what? The big picture doesn't always show you what's happening on the tree, right? Maybe the leaves are dying. You can't see it from so far above. Right? So you have to have both views, right? You have to look at the market in both ways. Okay, so here's a few reasons why we do it. to give us a look at patterns within a pattern, right? So if we look at a pattern within a pattern, sometimes doing so can give you a better entry, right? So you might look at a pattern and go, wow, that looks interesting, but man, I don't think that I can get that. The stop is too wide, and perhaps that stop is hurting your risk to reward. Well, that's not good, right? So you might want to drill down, okay, and go, you know what? Now I can play this. I can get a different entry, a pattern within a pattern, so to speak. And now the risk to reward is worth it, okay? Next, determine when a shorter time frame might fail, right? A lot of traders, again, looking at a vacuum are going, this looks really good, but if the higher time frame is not in alignment with that shorter time frame, it's not so good anymore, is it? Okay. Determine when a longer time frame might fail. Okay. The opposite of what we just talked about, right? So drilling down and then going higher really gives you an ultimate look at the market. Okay. And then if you're getting multiple time frames in alignment, now you can also adjust your expectations. So it has a lot to do with management as well. Right? If you get multiple time frames in alignment, you're sitting there thinking, wow, this thing's got nothing above it or below it. I'm going to sit back and let this thing run, let this thing ride. Right? Why not? Okay. So multiple time frames, if you think about it, guys, in trading, is really everything, right? I mean, literally everything. Without it, it's hard to be a good trader. Now, can you do it from time to time and get away with it? Sure, you can get lucky once in a while, right? But it's much harder to do without looking at all the time frames. So I want you guys to take a look at this for a second, okay? Now, what do we have here other than 3 boxes? If you're looking at this right here, saying, wow, what is that? That's a little pullback. There's a pullback. There's a pullback. There's a pullback. But is this the same chart? Are they different time frames? What do we have here? Like, what are we looking at right here? Okay. Well, I don't know, because all we're looking at is just a couple few pictures, right? A lot of people look at this, and for whatever reason, and when I typically teach this, they look at it and they put them all together and they go, oh, it's just one chart. Well, I kind of purposely did it on that, you know, to trick people, so to speak. They look at this, go, oh, the stock is moving lower, and then it's moving higher, and then it pulls back a little bit and moves up and pulls back and moves up and pulls back and moves up, and then they go, oh, you just kind of took one chart and you segmented it, right? You took the one chart and you just chopped it up into 3 pieces. But we're really looking at the same picture. You just happen to chop it up into 3 pieces. Maybe, right? But to be honest, that's not what it is. You're actually looking at 3 different time frames, right? You're looking at the same chart on 3 different time frames and go, but how could it look so similar, right? And we'll take a look here in just a second. One of the things you want to do, again, and this is another part of multiple time frame analysis, is take a look at what these bars mean, right? An individual bar looks different on different time frames, right? So you look at this and it just looks like a nice uptrend. You just happen to see some blue around the box. If I took the blue off, you'd think it's the same chart. You'd think it's the same stock. Fine. Okay, fine. But one of the goals is to find out by drilling down what is inside those bars. So if you look at this on a 5-minute chart, you have a wide range red bar here, which represents a lot of sellers, right? And then you have a wide range green bar over here that represents a lot of buyers. But a lot of people go, well, gosh, I can't buy it till it breaks the red bar's high. So I trap all those sellers in and put my stop down here. But look what it does. It kills your risk to reward, right? I mean, it doesn't kill it, but it hurts it, right? It hinders it. It hampers your risk to reward, okay? Well, that's on a 5-minute chart. Can't we look at other time frames? Isn't it possible for us to look at other time frames and say, hey, wait a second, maybe this is an entry. Maybe we can get a great entry on this. Well, there's a 2-minute time frame, right? Your lower highs, your lower highs, your lower highs, red bars, red bars, red bars, followed by a green bar. So now we can get in this stock over here with a stop down here. Whereas previously, if you traded in a vacuum and you only ever looked at one time frame, well, you'd be stuck taking a wide stop on this, killing your risk to reward, and waiting too long to potentially get in it, right? So this is one prime example of how drilling down to a lower time frame, even though they're similar time frames, a 5 and a 2-minute, gives you a better entry, right? So this is an example of how we can refine our entry on a stock we already like, right? This would be refining an entry, getting a better entry with a better stop and a better risk reward. Now you might even be taking a first target up in here, whereas this person's just getting in. So you have a much better entry, and you potentially could be out at a first target while they're just getting into it, okay? So let's flip back. You guys remember this chart, this slide, okay? Now let's jump ahead. There it is, okay? That's that slide right there. Just 1 second here. Give me 1 sec, guys. Sorry about that, guys. My apologies. So now we're going back and we're looking at those same three charts. What about those three charts? Well, the bottom one was this one, the middle one was this one, and the top one was this one. If you notice, this is a 15-minute chart, this is a 5-minute chart, and this is a 2-minute chart. So if we go back, I just kind of happened to line them all up, and I did it on purpose, but I lined them all up just to show you that it might look like one big trend, but realistically, it's a step-by-step process. We're looking inside the bars first, okay? And then by looking at inside the bars at different time frames, we can get better entries. And here's a prime example. Here's a 15-minute chart with a little bit of kind of a nickname we call it, a little bit of a bear sandwich right here, right? You have a wide range bar bouncing off the bottom after multiple bars down, right? So that's a good sign, right? That's a sign that buyers are stepping up. But then all of a sudden sellers come in. A little bit of a concern, right? And then buyers come in and engulf that. Now, could you buy it above there? You could, right? You could buy it above there and put your stop perhaps under here. But it kind of hurts the risk to reward. And then you have this pivot area up here that you're likely going to have to respect, right? So that could be a first target area potentially, right? Well, that's not good, right? That's not good enough, I guess is what I want to say. You buy it here, stop here. It doesn't give us much of a risk to reward. Now, there's no prices on here, but you guys can see that that area right there would likely be a first target because it's a prior pivot, and it's not that far away. But if we drill down, go to a 5-minute chart, now we're cooking with gas. Look at that beautiful pullback. This red bar represents these 3 red bars on a 5-minute chart. Right? So by using the multiple time frames, right, we're able to adjust and get into a position that looks good that really didn't have a great risk to reward, and we're able to do so by drilling down and getting a far superior entry, right? Better price on the entry and a better stop, right? Better price on the entry and a better stop, okay? 1 second here, guys. My apologies again. All right, sorry about that. I'm back. Okay, so multiple time frames is key. And now, again, now we're on a 5-minute chart, and we're moving up some more. All right, we are in a bit of a target area now. You can see this area right here, right there where my cursor is, that's this area up here. You can see there's a reaction to it. Well, there's a reaction to it, and you might say, well, the level of penetration here is really good, right? It climbed deep into enemy territory, so to speak. That's good. That means the higher it moves into this pivot, the more likely it's going to break this pivot. But the problem is on the 5-minute chart, when you get there, you're up 1, 2, 3, 4, 5, 6 bars. So you can't really add to your position up here because you're up 6 bars, but you do get a small pullback. That small pullback, okay, I apologize, Steve. I honestly am not sure. I didn't see your original post. I haven't even been looking at the screen. My apologies, guys. I just looked at it here for the first time. So this small pullback, this red bar, is another PBS on an even lower time frame, right? So if you go here up to here, if you just took the 15-minute chart and you missed that entry, that was a tough one, and there's no entry here. But if you drill down to lower time frames, you can refine your entry points. You can get better entries, right? And not just better entries, okay, but better risk to reward. I guess you could call that a better entry, right? A better risk to reward is a better entry, so to speak, okay? 1 second again, guys. All right, I'm back. My apologies again. So at first glance, multiple time frames are pretty important, I'd say, right? I mean, you look at multiple time frames and you're thinking, how did I ever trade without them, right? Because not only are you getting some confirmation, but you're also getting far better entries. And those better entries are not just higher odds because you're getting better confirmation. Those entries are also going to give you a better risk to reward, okay? So when we look at things in multiple time frames, you just get more clarity, right? You get a lot more clarity. And we went from a 15 all the way down to a 2. And you know, even here, this is that 5-minute PBS entry. You might have gotten an entry there, okay? So multiple time frames are very, very, very important. Let's switch gears a little bit. Now, let's take a look at this 2-minute chart for a second, guys, okay? The optimal time frames, Todd, I'll talk about that in a couple minutes. Give me a couple minutes and we'll talk a little bit about that, okay? Let's take a look at this 2-minute chart, okay? Stage 1, 2, 3, and 4. All right, you're in an early stage 4 downtrend here. 2 minutes, so it's a relatively short time frame. We're far below the moving average here, okay? If you notice, we moved up in the morning. We put in a little double top, you know, 10, 10, 30 reversal time, and this suggests sellers are coming in this area. Call it 65-ish. Call it 65, okay? And once we break this area here, there's nobody left, right? So we move higher. We put in a little double top, and you think, that's not good. This should have moved higher. Why didn't it? So now I'm questioning the trend of the stock. I'm questioning the strength of the stock overall, right? So we do move below this area, and that's definitely weak. Okay, so we move below, we bounce, and we continue lower. So now you're looking at this going, wait a second. On a small time frame, I'm not talking about a daily. The daily could be, you know, very bullish, but on a micro time frame, you're looking going, wow, this stock looks lower, right? So if you're looking at this where the yellow star is, ask yourself, is this a good trade, right? Should I short this stock right here? Should I short it right here? Is this a good trade? Okay. Well, the answer is what? What do you guys think? Is this a good trade? Is this an area that you would short a stock on? Again, you have a double top, right? That's a bearish sign because the stock was unable to go higher. So you have a double top after an extended move. That's typically bearish, right? You're breaking under this area, which is support, which means, well, it's weak, right? If you can't put in a new high and you break support, generally equals weakness, okay? So some of you are saying, yes, that's a good trade. That's worth a shot. Well, it might be, and I stress the word might be, right? You're under the moving average. That's bearish, right? You're putting in a lower pivot high, bearish. Lower pivot lows right here and here, bearish. I mean, all of those things say bearish, 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 right? You get a little topping tail, a little doji bar, narrow range bar. You get a good risk to reward. You know, you have a little double bottom here, so maybe you cover a little there and then let it go. I mean, that's maybe what you're thinking. But vacuums are hard to trade in, right? Vacuums are hard to trade in, and we're only looking at a 2-minute chart. So now let's change a time frame and say, what are we really shorting? What are we really shorting here? Okay, so again, that's a 2-minute. Let's move up a time frame, right? So if you saw just real quick on the last slide, we moved down a time frame to get us a better entry, right? So in this slide, we moved down a time frame to help us get in the stock, right? Okay. Now we're going to move up a time frame from a 2-minute to a higher time frame to keep us out of a stock, keep us out of a position on the short side, right? So when you look at this, you're going, whoa, wait a second. This is the same stock. Are you serious? Right? The 2-minute looks so beautiful, right? It looks like this little double top. Sellers come in, you break support, and you're moving lower. It just looks like the trend's going to continue, okay? And then, boom, you look at the 15, and you're like, oh, my goodness, what was I looking at? You have a gap up, right? A gap up over this congestion and consolidation. That's good. That's air above, right? Void, clean space. It means room to go higher. So you're gapping above that. The stock has an early morning run up, and it pulls back. Where does it pull back to? The low of the day and just above these prior pivot highs. I mean, that's a beautiful area for this stock to pull back to, right? So you pull back to this area, support, You get a bottoming tail. You get all these beautiful things. And you're on, oh my goodness, what a beautiful, beautiful 15-minute PVS. But if you only looked at the 2-minute chart, because let's be honest, a lot of new traders do that, right? They look in a vacuum and they don't look at anything else. They get so excited about what they see in the vacuum, they forget to look at the higher time frame. And that higher time frame might not be conducive to shorting this stock. And as you can see right here, you would have been shorting a perfect buy opportunity on a higher time frame. And the higher time frame is almost always more valid than a lower time frame, right? Almost always more valid than a lower time frame, okay? So when that PSS fails, because it will, right, then you're going to get the confirmation you need to buy this PVS. So you can see here how we've looked at one example where we drilled down. We started with the higher time frame and drilled down to get a better entry. And we looked at another scenario where we started with a lower time frame, we moved higher just to confirm. And once we moved higher, well, what we saw isn't what we wanted to see in terms of shorting, right? You saw the 2-minute and you thought short. You saw the 15, and now you're no longer thinking short on the 2-minute. You're thinking the only thing this play is long, right? So without looking at those multiple time frames, you're in big trouble. Now, somebody asked, who was it? I can't remember here. What are the optimal time frames? Todd asked that. That's a good question, Todd, but the answer to that question is tough because it really depends on what type of a trader you are. For example, Todd, I'm predominantly an intraday trader, okay? So I trade mainly 1, 2, and 5-minute charts, okay, with the occasional 15. So for me, when I look at what I call a higher time frame, I'm looking at a 60-minute chart, a daily chart. That's about as high as I need to go for how I trade. Right, a 60-minute chart or a daily chart would be kind of that bias time frame, give me the direction, the trend of the stock, and then drill down for a refined entry. Now, if you happen to be a long-term core trader, and you typically take trades on weekly charts, potentially monthly charts, well, you can't really go much higher than a monthly chart. I mean, you could go a yearly chart, but you'll be as old as Warren Buffett by the time a trade triggers, right? I mean, gosh, if this was a yearly chart, you'd have 1, 2, 3, 4, 5 years just for the setup, and then another 5 years, so you have a 10-year target there for $2. Well, in this case, probably more than that, but so it really depends on what type of a trader you are. Okay. One of the things I like to tell higher time frame traders, swing traders, core traders, people using daily and weekly charts is drill down for better entries. Just like we talked about up here, a lot of higher time frame traders, and I'll use weekly chart traders. Okay. If you take a trade on the weekly, you'll get a good trade, but your risk to reward will be hampered because your stop loss will be so big. If you guys noticed on a lot of weekly charts, you have 10% stop losses, $5 stop losses, $8 stop losses. So the stock goes $30, you make 3 to 1 on your money, 4 to 1 on your money. Well, if you could drill down and get that type of an entry, say it's a daily entry or a 60-minute entry, now you might take that 4 to 1 and turn it into 10 to 1, right? And if I have time towards the end, I'll give you guys a good example of something we did here at Pristine. We traded a stock called DAL. I don't know if is it Delta? I don't remember. It's an airline. But anyway, and we took it as an intraday entry with about a 20-cent stop. The daily entry was a $1 stop, right? But we took it as an intraday entry, and at the end of the day, the stock was so strong, it held so well that we just kept it. And we kept it as a swing trade because it closed so strong. And that stock ended up going $10. Now, if you took it as a swing trade with a $1 stop, you got 10 to 1. Well, 10 to 1 is a nice return. There's no doubt, right? $1 stop, $10 move, great. What about a $10 move on a 20-cent stop, though? That sounds a little better. That's 50 to 1. So 50 to 1 to me sounds better than 10 to 1, right? So all of that, again, comes down to refining your entries, okay? Refining your entries, okay? So I'm going to give you guys a couple examples of what I mean by keeping it simple and using multiple time frames, all right? Sorry, guys, let me catch up with a couple questions here. DH, we're going to be talking about volume, actually, right after this, all right? Volume will be the next topic that we discuss. Anna, yes, all I trade is technicals. I am not into indicators. The only indicator that's on my chart would be a moving average, and even that sometimes I don't use that often. But yeah, everything I do is technical. I mean, I'll be honest with you guys, there's nothing else you need. I know that there's going to be a lot of folks today, guys, saying, oh, you know, you need this, you need that, I use this, I use that. Everybody's got their angle, all right? Everybody's got their angle. Hence, there are over 200 indicators out there, right? You got MACDs, Fibonacci's, Bollinger Bands, stochastics, you name it. And everybody can tell you why that indicator's great. But my whole thing is, if any one indicator is so great, why are there so stinking many of them, right? If any specific one, because there are well over 200, is so darn good, why do you need the other 199? I mean, why did so-and-so make this one and so-and-so make that one and so-and-so make this one? We don't need any of that. To me, I don't want to call it garbage, but for my own personal trading, it would fall into that category, okay? Now, I don't mean to step on any other people's toes when I say that. I'm just saying that because I don't believe that that's the core of a chart. The core of a chart are candlesticks and volume. That's the core of a chart, all right? Everything else is noise to me. Now, you might say the opposite. People will come in and talk for an hour and tell you, well, it's the opposite of noise. It helps me refine the noise. Without the indicator, it's noise, all right? And people will tell you that, okay? But what are all those indicators based on again? Does anybody know? All those indicators we just talked about, what are they all based upon? Does anybody know what every indicator in the world's based on? That's one letter. Yeah, price. So without price, how good is the indicator? Exactly. Therefore, isn't price the most important thing on a chart? Not the indicator. So I look at it that way. I really keep trading, I guess I simplify it to its core. And I think it helps traders learn faster, but it also teaches you what's most important, which is the price. Okay. In a 15 minutes, is there any way, there's a resistance area, followed by a bearish candle? You could take a quick, you could, Claudio. I mean, again, it depends how aggressive. When you say quick, are you talking about a nickel dime? Are you talking about, 50 cents? Are you talking about being in and out? Yeah, I mean, I don't have a problem if someone were to do that, Claudio. I think it's overly aggressive, but I know traders that are that quick. They're in and out, click, 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 hotkeys, bam, and they move on. Right? So I don't necessarily have a problem with that, but if you're looking for a larger term move, you're not going to go against the higher time frame trend like that. And if you do, you're probably going to get burnt if you're not very agile. But I can't necessarily disagree with, with that approach per se. Are binary options a reasonable investment? That's a great question, Joe McDonald. I would ask somebody that knows a lot about binary options. I can tell you I know about as much about binary options as I know about binary options, which is nothing. I don't know anything, literally zero about them. I don't trade options. I don't trade futures. I don't trade Forex. I just trade stocks. So I wish I could help you further. I apologize that I can't. All right. So let's take a look at this here for a second. Okay. Yeah, and I'll show it to you when I'm towards the end. I'll save like 5 or 10 minutes so you guys can ask some questions, and I'll bring it up for you. Sure. Yep. So as I said to you guys earlier, I'm a lower time frame trader. I'm a shorter time frame trader. Okay, I like to trade short time frames. Okay, well, because I like to trade short time frames, when I start with a quote unquote higher time frame, that higher time frame to me is probably a 60-minute chart or a daily chart. Now, if you're a swing trader, you're going, whoa, a 60-minute chart's like a low time frame. Well, it would be on a higher time frame long-term trader, but I'm a short-term trader. So I use the 60 and the daily as what I call my bias. My bias means the trend, right? Is it long? Is it short? Is it higher? Is it lower? Is it sideways? Well, to me, when I look at this stock, I see a stock that moved up and it consolidated out and it held this area of 54.50 very well, but was unable to push higher, right? So when I look at this, I think this is a problem. Why, after such a resting period, 4, 5, 6 days, whatever it is, why was this stock not able to push higher? If it's not going higher, then it's not as strong as you thought it was. So if it's not as strong as I thought it was, I have to question maybe it's a short play, right? So I have a square top, not a V top, more of a square top. And if I break under this area, notice the bottoming tails? That means buyers are stepping up. Buyers are stepping up. Buyers are stepping up. Buyers are. So if you can get under that area and take out those buyers, there's nowhere for this stock to go but lower, right? Because you had a relatively easy, smooth move up, okay? And you're likely to have a relatively easy, smooth move down, okay? But you have to know your parameters, right? You have to know your parameters. So my parameters are 54.50, right? Which is the last bastion of strength, which is the last area buyers might step up, down to, call it 52.50, even though it's a little above that, because that was the last area buyers previously stepped. So I know I have a $2 range on this, and that's important. Why is that important to me? Well, it's important because when I manage the stock, when I manage the trade, I have to know where the buyers are likely to come back in, right? So I know I have $2, and for me, $2 is plenty, right? Because I'm not taking a dollar stop loss or 80-cent stop loss most likely on this stock. Okay, so that's my playground, so to speak. I have $2, 54.50 to 52.50. My goal, my job, I need to find a lower time frame entry. How am I going to short this thing? Right? I don't have a great entry right here. Right? The thing moved down 4 bars. It put in a green bar. Once it breaks under that area, I need an entry. Well, there's my entry. I go down to a 5-minute chart. Notice the stock consolidated out with topping tails now, and notice the moving averages are now going lower. Again, this is the only indicator I'll use, and you don't even need this. I mean, I don't really need moving averages to tell me the stock is going lower, right? A lot of people just like to see the guide of the chart. So I don't have a problem if you didn't even use a moving average, okay? But you can see a beautiful tight consolidation, right? Oddly enough, where's it at? 54.50. Let's go back. The line in the sand is 54.50. So we have a stock at 54.50 consolidating in a very bearish manner. And then once it breaks that area, we've already discussed it. Let's go back again. There's nothing here. There's nothing to stop the stock. Maybe a little concern at 54 with the flat 200, but that's about it, right? So you have yourself a 15-cent stop right here, okay? 54.50 by the high here is 54.65. You really, really, really wanted to give it a super wide stop, 30 cents. Right, the high of the day is 54.80. So 30 cents would be about as wide of a stop as you could give it. And oddly enough, where did the stock stop going down? Right around 52.90-ish. Well, you know, it's not perfect science, but that's pretty close to what is that green line again? About 52.70, 52.60. So 52.90 is not bad, right? So you can see the stock stopped going down in that area and put in a double bottom and looked like it was about to bounce. So if you're trading this stock and you're managing it on pivots, down in this area is a target, right? It's your full target. It's your final target. You need to know that. And the higher time frame not only gives you the bias, which is short, it also gives you the range, the expectation. The lower time frame gets you in on a better entry with a better stop and a better risk to reward. You could have taken it, you know, with a $1 stop and maybe you get 2 to 1. But if you take it with a 15 or 20-cent stop, now that $2 is more like 10 to 1, 15 to 1, right? It's a pretty big deal, okay? And then if you're really an astute trader, and this won't happen on every trade, you'll also take the market and get that in alignment as well, right? You can use the Qs, you can use the spiders, whatever you like to use, but notice we're breaking under support in the market right here at 10:30, and we have a new breakdown at 11. And let's take a look at the stock. When did the stock trigger? Just past 11 o'clock. Right, just past 11 o'clock, okay? When did the market continue lower? Just past 11 o'clock, right? The SPY were breaking under, I guess it was 118.50 at the time, all right? So you can see the timing with the market was great. The higher time frame was great. The lower time frame was great. Everything was great, right? Higher time frame looks good. Lower time frame looks good. Market looks weak. That's a trifecta, right? Putting it all together. Okay, putting it all together. All right, here's another example. So I have to move on to volume. I think Morgan, do I have till? Is it 11:15? Is that the time I have till? I just want to double check. I apologize. I don't have it in front of me. So here's another example, guys. Notice when we break under this area. Okay, there's nothing here. I'm using a 60-minute chart again. There's nothing down there. The stock tried to go higher and failed. It gaps down to this area. Once we break that area, we call it support, right? There's nothing, 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 nothing. So if there's nothing down there, my expectation is going to be relatively big because, well, there's no support. The market happens to be weak, and once again, I have 2 entries here. I have a little sell setup right there, right? A sell setup right here, and I have a little breakdown right there. Okay, thank you. Appreciate it. Okay, so I have a sell setup here and a breakdown there. Now, again, the higher time frame is nice, but how do you trade that? I mean, you could short it at 48, but your stop has to be above the high, which is $50, right? So you could short it at 48 with a stop at 50, but that's $2. Man, that's a tough risk to reward. I mean, if you get a If you get a $3, $4, $5 drop, it's only 2 to 1, 3 to 1. Whereas if I can get a 10-cent, 12-cent, 15, 20-cent stop, now I got a 70-cent move, and that 70-cent move is actually meaningful. It's 5 to 1, 6 to 1. Okay, all right. So I wanted to give you guys just a couple examples of a couple trades I took recently. Actually, they're kind of old. Actually, they're about a month old or so. But I want to show you that there are different styles of trading. You can have a hit and run approach, which is more how I trade. I get in, I get out, I move on. I get in, I get out, I move on. All right. I'm not looking for huge moves. Now, I will sometimes save, a third of my position, 25% of my position for a larger move. Okay. But here's a trade that I called in our chat room and took myself right here, a wide range bar, little consolidation. Notice the wide range bar, what it's taking out. It's taking out the pivot, and the pivot. Right? It's taking out all of this, so there's nothing else up here. It moves up quick 60 to 70 cents, right? Pulls back and then moves higher. I'm not in it for the pullback. I'm in it for the quick pop, and I'll show you. Right here, okay, that's the same stock. You can see the entry. It was 2 minutes. Literally, you can see my fills, right? I was in the trade for 2 minutes, right? 2 minutes. I'm looking for 2 to 1, 3 to 1 max, 2 to 1, 3 to 1 next, 2 to 1, 3 to 1 next, right? And you can see that right here. Looking for a 30-cent stop, right? That's what I have. It moved about 70 cents, so I got a little more than that, right? And that's it, risk, some money and double it, move on, okay? You can see here, this one gave a far more significant move, right? And this is one I honestly, I wish I put the higher time frame on. I apologize, guys. I like to put the higher time frames on so you guys can see what I'm talking about. But check out at 95, okay? And the stock went 5 to 1. All right. But again, I'm not going to be in it for that. I'm going to be in it for just the move up and done. Some of you may hold for the pullback and get the monster move. But again, $1,600 in 8 minutes isn't bad, right? $1,600 in 8 minutes is decent money. Now, does every trade go in 3 minutes? No. Some trades take 45 minutes to move. And I wanted to show this because this is actually from our chat log in our room. These are stocks that I mentioned. Watching DDD over 96 and SCI over 50, that's 5 minutes before the market opened, right? And you can see they were on our gap list 30 minutes before the market opened, right? DDD was on my morning watch list. SCTY was on my morning watch list, all right? So these are the posts that we put out before the market opens, okay? Before the market opens, all right? Now, right now, I think we're having an open house today in one of our chat rooms, but the point is that these are the things that we do in our Pristine chat rooms. I look at things pre-market, and I get ready for the first 30 minutes of the day. Right? And for the first 30 minutes of the day, I rely on basically that list, right? That list of 10 stocks. They're my favorite stocks, okay? These are my favorite stocks because they're doing something special on a higher time frame, like a 60-minute or a daily chart. For example, they would be my favorite because they're doing that perhaps on a higher time frame, right? So pre-market, I look at this and go, wow, if it breaks 54.50, I'm interested. If it goes higher, well, move on, next. If it breaks, I'm interested. If it goes higher, next, right? That's the beauty of being a stock trader, right, guys? Isn't that the beauty? We're not an analyst. We don't have to cover a certain stock, right? You think about what I just said for a second. I'm not an analyst. If you're an analyst, you have to cover the banks that you cover. You have to cover the companies that you cover. We can literally just go next and move on to a stock if we don't like it. Isn't that beautiful? There's thousands of stocks out there. It's one of the reasons I don't trade futures. There's like, the ES, the YM, the NQ. There's just not enough products for me to trade. For stocks, I just get to go, oh, I don't like it, next. Oh, I don't like it, next. I don't like it, next. And then, oh, I really like this one. Let's trade this one. Here we have a gap down. This would be on a watch list. If it breaks this green line, I'm interested. But it has to break the green line and give a pattern, give an entry. Okay? All right? So you can see that these are the things that we're looking for even before the market opens. And we'll adjust that list at 10 o'clock, 10:15 after the first 30 minutes. Okay? You'll find these ideas through scanning. Dollar gainers, dollar losers, gap ups, gap downs, volume gainers, volume losers, percentage gainers, percentage losers, NASDAQ. I mean, there's a gazillion scans out there, right? And we talk about a lot of those in our courses at Pristine, how you find these ideas, okay? The first way to find them, for those of you asking, is know what you're looking for. I know that sounds very simple, okay? But knowing what you're looking for is probably 80% of the battle, right? A lot of people can't find these ideas because they're not sure what it is that they're looking for. And really, that's what we teach in our courses, right? Let me see here. Let me catch up a couple questions. What is your risk amount on these trades? That's a great question, Cookie Bee. I typically around 500 bucks. There are times I'll go as high as 1,000. I'm most comfortable between $300 and $500. Those trades were about $500. So again, they were 2-to-1, 3-to-1, just like I said. They were 2-to-1, 3-to-1, and that's all I'm looking for: 2-to-1, 3-to-1. And I'm going to show you a couple things here in a few minutes when we talk about kind of money management, so to speak. So we talked about multiple time frames, using higher and lower time frames to help you get into a trade as well as keep you out of a trade, right? Hey, Joel, how you doing? Right? We use higher time frames and lower time frames not only to help us get in a trade, but to help keep us out of a trade, and that's a very important aspect of trading. The next thing that we're going to talk about is volume. What can volume tell us? Well, it can tell us, I don't want to say everything, but a heck of a lot about a chart. So we focused on candlesticks, which is price. Now we're going to focus a little bit on volume. And here at Pristine, we have a few different types of volume. We have what we call pro volume, novice volume, and continuation volume. As it says, it ignites a new move up or down. Okay. It could also be the continuation of a move, to be honest with you. You could have a pause that refreshes, a consolidation, and it continues an already strong move. Okay. But generally ignites a new move up or down. Novice volume is in the same direction. A lot of people have a hard time understanding this, but it's in the same direction of an extended move. What this means simply is if you're up 7 days in a row and you have a big gap up on big volume, that's in the same direction of an extended move, right? 7, 8 days in a row up is typically extended, and then you gap up on big volume. That doesn't mean higher, okay? It means lower, and we'll talk about that in a second. And then continuation volume, it continues the current trend. Continuation volume, guys, is typically very low volume, very quiet volume, very ambivalent volume. You know, I don't care type of volume, right? So price tells us what the stock is doing, right? Tells us, hey, it's going higher, it's going lower. Well, the volume tells us how it's doing it. Is it going higher with commitment, or is it going higher with a lack of commitment? Because, guys, volume is money. Think about that for a second. Volume is money, right? Fact. If a stock has moved up $1 and there's 1 million shares printed, that's a lot of money, right? If a stock moves up $1 and there's 300 shares printed, that's not nearly as much money committed to the stock. So the more volume you see, the more commitment you see. So money represents commitment or a lack of commitment. Why is that important to us? Well, as much as we like to think of ourselves as great traders, and we like to think of ourselves as you know, significant in the marketplace, we're not significant. We are little peons. We're little grains of salt, little grains of sand on the beach, right? There is no way that anybody in here is trading the same size account as somebody at Goldman Sachs is trading. All right. I mean, if you have a, you know, $1 billion account or a $100 million account, then you're probably not here listening to me. Okay. So my point by saying that is you're not going to make the market on that stock. You are not going to move that stock, and you know, unless it's a highly illiquid stock. Point being, you want to follow the people that are moving the stock. You don't want to jump in front of the people. You want to jump behind those people. Let them clear the path, and you follow the way. You don't want to get trampled over by them. Let them clear the path. So money and volume, or I should say volume, is very important. The level of commitment is very important in a stock. It tells us a lot. Okay, it tells us a lot about a stock. All right. So volume increase without price movement, warning sign. That's bad. Right? If you see a huge volume spike and the stock goes nowhere, expect a shakeout. In fact, I'll give you an example of something we traded yesterday. I think it was CTRP. All right. Was a prime example of a stock that shook the tree on huge volume and then went in the direction you intended it to go in. Right? Breaking out or moving without a volume increase is also a bit of a warning. It's okay, but you want a little more commitment than that. So the next few slides are purely charts. We're just going to look at charts in the next 5 or 6 slides. So if you look at this stock, you have a gap up, okay? You move lower, you move lower, you move lower. Well, it could be a dark pool decay. It could just be an HFT, right? I mean, dark pools are typically blocks of shares that you don't see. They're interinstitutional trading, basically, when institutions trade with each other and they just show up. A lot of times you can see this volume, but Sometimes you can't, right? Sometimes it's hidden. There's a lot of games that are played on level 2, right? So right here, guys, we have what we call continuation volume. Continuation volume is resting volume, right? It's volume that allows a stock to rest so that it will later on eventually continue that trend, continue that move. So this stock was trending down on a lower time frame, consolidating at a whole number at $85 in a very, very narrow range. The volume was very light. But as soon as it broke, that's your pro volume. That's igniting this move lower. That's what you want to see. Notice the stock was doing maybe 10,000 shares per bar. Every 5 minutes it was doing maybe 10,000. And all of a sudden it puts in 130,000 shares. That's great. That's exactly what you want to see. And it also dropped $2, more than $2 actually, right? That's the pro volume, because that lets you know that there's other people interested in this stock. You're not the only one. You're not on an island here, right? There are a lot of other folks that want the stock to go lower, okay? Take a look here, right? This is a trade from, what was it, a couple days ago? Last week? I don't remember. There it is, the 12th, all right? February 12th, all right? This is a recent trade that we took in the room. Now, that right there, 1, 2, 3, 4, 5, 6 days up, okay? Now, the stock bounced off a double bottom, that's bullish. But, 6, 7 days up, that's a lot. Notice this volume right there, guys. You're up 1, 2, 3, 4, 5, 6. On the 6th day, you get a monster volume spike. Monster volume. I mean, it's huge volume, right? 24 million shares or something when the stock does a few million, right? 8 to 1, 10 to 1, whatever it is. After multiple days up. Now, if that volume came at the bottom, oh, you'd be buying this stock all day and twice on Sunday, right? If this volume came at the bottom, you'd say, wow, extended, double bottom, buy, buy, buy. But when this volume comes up here, and a lot of new traders don't understand this, they look at it and go, oh, it's bullish, it's bullish, it's bullish. Well, long term, it's bullish. It'll probably pull back and then go higher, right? Pull back and go higher. But short term, which is what I'm looking for, this is bearish short term. Well, that's the 2-minute chart. Now, we saw the volume on the higher time frame. I need a pattern on a lower time frame. Well, there's my pattern, right? Up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars. Topping tails represent sellers. Bar from the moving average means extended and tired, okay? Multiple bars up, extended and tired. And look at the volume. That's the last spike. That volume bar right there tells me that every last person that wanted to buy this stock, yes, guys, it's crazy to think, but there are actually people buying this stock up here, right? You and I are looking at this and go, are these people nuts? This stock is up $3 in 15 minutes, and there are actually people buying it. You're up 6 days on the daily chart, $3 in 10 minutes, and people are still buying this thing up here. Now, to somebody that doesn't know any better, well, I guess that's a normal thing to do. To a professional trader, that's insanity, right? You're up 6 days on the daily with huge volume, and you're up $3 in about 10 minutes, and you want to buy it? No. That volume tells me that, again, everybody's mother, brother, aunt, uncle, sister, second, third, fourth, fifth cousin removed is in this stock. And when they're all in it, there's nobody left to push it any higher. So we shorted it right there at 66.50. 50-cent stop, shorted it right there. Right? As soon as this bar broke the prior bar's low, shorted at 66.50 with a stop at 67.01. Okay, and watched it tumble like a stone all the way down close to $63. First target was right here at 65.50 because that's the moving average. That's first target. So first target was 3 to 1, and last target is going to be support right there. So we actually would not have gotten the last 50, but 64 would have been the final target. First target, moving average. Second target, support. Because again, the daily has novice volume. Novice volume ends a move. It's extended, gaps up, big volume. Not only big volume on the daily, it comes in the first 20 minutes of the day. It pukes out to the long side. All right. Tesla's a little different because Tesla, I think, Diane, I don't remember, correct me if I'm wrong, but didn't Tesla gap over a red bar? Isn't it just an earnings gap that's only up a day or two or something? I don't remember. I have to look at the daily. I saw it this morning, but this is different because, again, I mean, I'm not saying you couldn't have shorted Tesla maybe at, I don't know, 210 or something like that, but this is extended on a higher time frame, extended on a lower time frame. All these topping tails, guys, they represent sellers. Look at that volume. Now look at the volume later in the day. Just take a look at it for a second. Look at the volume later in the day at noon. You know, nothing. Look at the volume here. You're doing 1 million shares on a 2-minute bar. 1 million. Down here, 50,000 maybe, something like that. Okay, that's money. But it was only possible because of the volume, right? If this moved up like this but had no volume, like if, for example, if this moved up like this and had volume like this over here, I probably would let it go. I know it sounds crazy, but it's true. If this stock moved up, okay, all the way up into here, sorry, okay, and had this type of volume, I probably let it go. I probably let it go. Here's a trade that we took a while back. Wide range bar breaking under this area. Beautiful. Okay. Couple consolidation bars. Notice the volume is light. Call that continuation volume. Light volume on the consolidation. Okay. And then what happens? You get pro igniting volume and then novice ending, right? That right there is continuation volume, light volume. Right there is pro igniting volume for this bar. And now you're down 1, 2, 3, 4 bars. That's it. It's the end of the move. Right? It's the end of the move. In fact, I wish I had it because it moved back up to 1950. This stock actually came down and moved back up. Right? So you got everything you wanted. You got a nice wide range bar pushing under support, a little bit of continuation volume, pro volume ignited, and then novice volume says, hey, that's the bottom. That's the bottom. Right? Why do you not you look at volume on each price and not the candles? Have you tried it? DH, are you talking about level 2? Or is that what you mean when you say at each price? I do look at level 2. In fact, I don't know if I threw level 2. Oh shoot, I didn't. I was going to throw level 2 on here. I'll show you exactly what I mean. Give me 1 second, and I'm not going to get deeply into it because I don't have the time today. But I'll give you a great example of I believe what you're talking about. And maybe I'm wrong. Maybe you're not talking about exactly this. Okay. But if you give me a second, let me bring something up here. Where is this at? I know I have it pretty soon, guys. Give me 1 sec. Here it is. I do look at level 2 stuff. Okay, I do look. Okay, DH. I don't know if that's what you're talking about, but I do look at price points. I do look at that 600,000 shares, and I see only 3,000 on the bid here. I do look at that, and then I go to the next one and go, oh, that 600's down to 580. Now there's 46. I do look at these prints, absolutely, right? And now we're down to 530, and now the bids are increasing. Now we're down to 390, and the bids are increasing. Okay. Now we're down to 175, and the bids are increasing. This balance of power is shifting, right? This was over here was 700,000. It's printed over 1 million shares. The buyers are getting more greedy, so to speak, right? They weren't that interested earlier. Now they're hugely interested. The sellers are waning now, right? You got them on the ropes. And then next move, stock goes higher. So, in that respect, I do. Now, if you're talking about futures and Forex, well, that stuff is, well, a little less important in terms of liquidity, but level 2 is still an important aspect of trading, all right? Here is an example, guys, of the same stock with different volume, okay? For example, here's a stock in a sideways trend, and we have a wide range bar right in here. That's pro-igniting volume, right? That volume there is pushing the stock over resistance, okay? Pushing the stock over resistance, moving higher. But after it's moved up 1, 2, 3, 4, 5, 6, 7, 8, 9 days, not only do you have 9 days up, you're far from the MA, red bar, topping tail, huge volume. That's it. It's over. That huge volume says it's starting. That huge volume says it's finished, right? And that's how you have to read the chart. So it's not just the volume in a vacuum. It's the volume with the price and the location of that price, right? And those are topics that I don't have time to get into today, but where it happens on the chart, how it happens, all of those things are very important. So you notice this stock is up 8, 9, 10 days. Then it has a big topping tail. Then it has a red bar. Then it's far from the moving average. All of those things you have to put together. But I don't have time to discuss all of those things today. Okay. Now, I wanted to go over this one because this was something that happened yesterday. All right. And I don't know if there's anybody in here today that was with me yesterday, but I was actually on the mic when this happened yesterday. And I specifically said, guys, this stock is going to shake, okay, and then it's going to go lower. And for anybody that was in the room at the time, they can confirm that at the time, all right? I actually, somebody sent me an email saying, Jared, thank you so much for explaining this, okay? what happened is this. This is a 1-minute chart down here. Okay, I apologize. I should have put 1 minute. This is a 5-minute chart. This stock actually broke $50 right there. I don't know if you can see it. It's really small, but I hope you can. It broke and shot to the moon, trapping all these people in, sucking up all their stop losses. And then what did it do? It dropped $2 after that. So basically you had some computers coming in, and this was looking at the level 2 and using volume. And it dropped, and I said, guys, this isn't good. The stock dropped like 8 cents or something on terrible volume. 600-700 shares of volume, okay? And then pop, it shook the whole tree out on big volume, came right back down. We shorted it right as soon as it came back down. I mean, you had to be on it. I mean, if you weren't staring at it, you didn't catch it. And then it just dropped like a stone, right? So this stuff happens, right? You can learn from looking at volume and the level 2, and I'm not here to talk about level 2 today, but you can learn a lot from how volume forms, right? It broke down at 50 and then nothing for a few pennies. It shook the tree, shook just about where all your stops would be. It shook and then went lower, $2. Okay. I don't, Maverick. No, I don't. Okay. Here's one last one, guys. And again, here's another example. The stock was moving lower in a downtrend. And why did it bounce here? I don't know. I don't have enough information to the left to know why it bounced there. Maybe there's a pivot here. I don't know. But it bounced here. It was extended down and it bounced. It pulled back. It bounced again. So if you notice, now we have a precedent. Sure, I'm going to look for a stock to pull back in that area. So now I have a stock that's bounced in the same area twice and a stock that's pulled back in the same area twice. Now, when we get this, I see 1, 2, 3, 4, 5, 6 red bars. And look at that volume, right? 6 red bars. Buyer stepped up here. Buyer stepped up here. Now I get volume. That is novice ending volume. That volume ended this current move down. And better yet, it's at support, right? All right. Better yet, it's at support. So we're 6 bars down, and I'm at support. Huge volume. You're going to buy it right here, stop right here. First target 50%, second target 100%. I'm not expecting it to break this red line. Sellers have come in 3 times. May not break it, but I can play it in between, and volume helps me determine that. This volume is that novice volume we talked about. Okay, so understanding volume, guys, is huge. It's absolutely huge. If you guys ask questions, I'll get to them in just a Hello? Can you guys hear me now? Can I get it just okay, great. Sorry, I unplugged my mic. I stepped on it by accident. Not my mic, but the cord. Sorry about that, guys. All right, so I'll answer some of those questions that you guys had in just a second, I promise. I've been lagging on some of the questions. My apologies for that, okay? So these volume concepts, guys, they become more important depending on where they happen on the chart, how they happen on the chart. So where they happen on a chart, how they happen on a chart, well, again, it makes the volume concept far more important and far more powerful. So those are the types of things you'll learn in our chat rooms. Those are the types of things you'll learn in trading the Pristine method, okay? So you should stop by Pristine, get a free trial in one of our rooms, and just see what you think about us, okay? And like I said, it's free, so you have nothing to lose to stop by. When you read price and volume relationships, guys, you will make your trades so much more accurate, so much more profitable, so much more accurate, right? You're not just looking at price by itself because it's meaningful, but you need volume. You're not just looking at volume by itself without looking at the location of the volume, right? So you have to put them together. You put those together with the multiple time frames, now all of a sudden you're cooking with gas, right? So in my opinion, I really believe the truly astute trader can trade successfully by relying exclusively on price and volume, okay? You can keep your trading simple, okay? Brian, yes, Pristine does have options, all right? But again, I don't trade options. You'll have to ask Ray or Amber about that. So keep it simple. Find a nice daily or higher time frame chart with void. Drill down to a lower time frame. Find a clean pattern. Stalk it patiently. Time it with the market, and then you manage in between. Okay. I wanted to show you guys a couple of things towards the end here. Just a few more slides, and then we'll call it a day here. But I took an account last year. We have some prop traders at Pristine. Okay. And our prop traders typically start with about 2,000 bucks in their account. Okay, so I did a little experiment, and the reason I'm bringing this up, okay, is because I want to. Earlier today, I told you guys respect the market. Remember that disclaimer slide, and I said this is a slide I really genuinely like to talk about because too many people they don't respect the markets. Well, you guys can't come in if you're new and risk the farm on a trade. You just can't do it, right? Because you haven't earned the right to do so. As you gain experience and gain profitability, you can do anything you want, right? Let me repeat that. As you gain experience and profitability, you can do just about anything that you want, okay? But in the beginning, you can't. So you realize that, and I hope you guys can see that, right, that these trades are relatively similar, right? Relatively similar, right? The difference is one made $4 grand and one made $97. Well, this trade was what, an 83-cent winner, okay? And this trade was a 97-cent winner. So again, relatively similar, 83 cents, 95 cents, whatever it is. One made $4 grand, one made $97. That's trading in a nutshell, guys. The problem with traders is they want to come in and they want this in their first day. It doesn't happen in your first day, right? In fact, you probably shouldn't be risking 100 bucks in your trades or $50 in your first start, maybe $10, $20, okay? And let me give you a good example of that, okay? This is an account that I traded last year, and you can see at the beginning of the year, $2 grand in it, all right? 2 grand, $50 risk. Right? That's it. That's all it was, $50 risk. I usually won't go more than 1 to 3% when I risk in a prop account. And guys, risking 2 and 3% is dangerous, right? You should really be at 0.5% or 1%, all right? But the reason let me give you a little caveat is if you're brand new, throw the percentage out the window. If you're brand new, throw the percentage out the window because you might have a large account. So a percentage of that might be too much money, okay? So if you're new, risk $10, $20, $30. I don't care if you're a multi-gazillionaire. It means nothing to me, okay? When you're new at something, you start small. All right. If you've never played golf before, would you play Phil Mickelson for $1,000 a hole in a skins game? I would think not. I would hope not anyway. If you've never played the game before, you probably wouldn't bet him $1 a hole. You're going to lose. So in the beginning of trading, be smart, right? So you can see, and I wanted to show you just the progression here, all right, that as you gain experience and as you build your account and things start going your way, you slowly build. This is a 68% return. Is that a lot of money, $1,400? No, it's not a lot of money. But you only had 2 grand, right? It's not much money, okay? But now let's skip ahead to the next quarter. I took one snippet from each quarter. I'm like, oh, well, now my account's growing. It's up to 4,600 bucks, okay? Now you're at $100 risk. So you went from $50 to $100 risk 3 months later. Well, now you're making 5 grand a month. Wow, that's not bad for 3 months down the road, right? So January you pull out 1,500, a little less, and now by May you're pulling out over 5 grand. And again, you're not setting the world on fire, but you're making do. Well, let's skip to the next quarter. Oh, now your account's up to 11 grand. Notice you're staying at roughly 2%, okay? Now, oh, you're up to $250 risk. But notice the return is still pretty similar, 68%, 116%, 68, right? Now you're at 7 grand, right? But you're still risking roughly 2% in this scenario, okay? In this scenario, okay? Next, let's jump towards the end of the year, next quarter. Now your account's up to so you went from 2 to 17,000. You're still getting roughly the same return, but now your risk is up to $400. Now you're up to 11,000 bucks. Think about that for a second. That's a slow, professional progression, right? You're staying at 1 to 3%. Again, this is for an experienced trader. If you're a new trader, throw that out the window. Risk $10, $20 a trade, period. Okay, but you started out the year making $1,500 a month. You ended the year making 12 grand. Okay, but notice the return about the same, 68%, 68%, 68%. One was over 100%. That was a good month. You know, about 30 to 1, right? Yeah, 30, 40 times your risk in a month. Okay, and on a good month, you might get more than that, right? This one was like 54 times your return, right? Your risk was $100, you made 54 times that. All right, in this particular month, your risk was 250, you made 30 times that. And this month, your risk was 400, you're 29 times that. But you can see in 1 year, okay, the progression that was made in 1 year. All right, Rome wasn't built in a day, guys. Just be patient, keep your trading approach simple, keep it smart, okay? And after a year or two, if you're smart and diligent, right, and you work hard and you follow the rules, you too can have those types of returns. It's just a product of your experience level, okay, your comfortability with risk, okay, your account size, all of those things. So don't try to do this in your first month, right? That's not smart. You'll get that eventually, right? You'll get that eventually, but you're not going to probably get it your first month, okay? Let me go back and answer some questions, guys. Pristine's having 25% off, guys, all their courses and services through February, but I missed a few questions here. I apologize for those people. Let me see here. Do I think silver will ever go up? Put it on a chart, and I can answer your question, Anna, to be honest with you. I know that sounds overly simplified, but that's how I trade. If you put silver on a chart, I could read a chart for you and say yes or no to that. But that's all I do. I only look at charts. I don't care what the company does. I don't care who the CEO is. I don't care what the sales are, the credit risk, the dividends, none of that is anything important to me. Entering a light volume. What criteria do I consider entering a light volume stock? I usually go small shares and have a wider stop if it's truly light volume. I don't like to trade light volume stocks, but you can if you want. I wish you look at a 5 minute instead of a 2 hour. I look at all of them all of the time. I look at all of them all of the time. All right. In fact, if I have a second here, I'll bring that up. I'll show you. I look at the 1 minute, 2 minute, 5 minute, 15, 60 daily, even the weekly, and then I look at the market. So I like to look at every picture all the time. I want to see the clearest that I can see. I don't want to leave anything out. Right? Let's see. I'm going to have another sim. I'm not sure what you mean, Melvin. I apologize with that. Does this principle apply? Yeah, all that applies in Forex, JT. Again, with Novice, Ending Volume, Pro, Igniting. But the difference in Forex is you guys don't have what we call light stocks or liquidity concerns, right? There are no liquidity concerns in Forex, but you will have volume spikes at times, sure. Do you use level 3 in your trading room? I don't use level 3 Maverick. Maybe some others do, but I don't use it. Okay. All right. Let's see. Sorry, I'm just catching up. What do I mean by void, KJ? Void means air, okay? Void means there's nothing above or nothing below. So, for example, KJ, when you look at this chart, do you see white space here? Ignore that for a second. Under this area, you see just white space. Void means kind of like the word definition, void, right? It means just air, right? Clean air, which means there's no support down here. There's no buyers or sellers. There's nothing, which means the stock should be able to drop continuously. Right? There's nothing holding the stock back from falling. And that's what I want to see on all of them. Right? I don't want to see space down there because if there's space down there, that could represent buyers. And that means, well, I have a smaller area to make money. Right? How do you find these trades before they happen? Most speakers, how do you find, Joe, I don't know why any speaker would avoid that before they happen. Let's do it for a quick second. Why would you avoid where you find these things? I mean, first of all, Joe, I just want to go back and say and show something very quickly. I clearly am not avoiding these before they happen if I put them in the chat room 30 minutes before they happen. True? Would you agree with that statement? This is our actual chat room, all right? Our actual chat room. And I'm putting in 5 minutes before the market opens, 30 minutes, and I'm saying watch it over this area. So clearly, that wouldn't be a truism for me here at Pristine because, well, I'm showing it to you right there. But let me pull the camera down for a quick second, okay? Because I want to. Oh shoot, I'm out of time. Can I? I'm trying to think, Joe. I want to just give me 2 more minutes, guys, and then I will move on. I apologize. I had extra time, and then now I don't. Give it 1 second, guys. The camera should be up in just a second. Give it a second. All right. Do you see this, Joe, right here? And I don't have, unfortunately, the time to go into great detail. This is exactly how I find those ideas, okay? You can see this is my list from this morning. I haven't tampered with this list at all, okay? I had PRAA on my long list this morning. What has PRAA done? Moved up. right? Why? Because PRA is a nice gap. It's moving above this pivot, and that would have been a target area right there. That 58.80 is a target area. So I saw this pre-market. And you're asking, well, how did I see it pre-market? Well, I'll blow this up real quickly. Go here, 24-hour chart. There's my pre-market chart. I'm seeing this pre-market. So I'm looking for the trend in pre-market, Joe. And after the trend, then I need to find an entry. Right? Then I need to find an entry. You know, we were looking at away this morning. That was another gap up. Right? If you take a look at this on a 2-minute chart, that's a great entry right there. You see that? That's a great entry right there on away. Now, why was I looking at away? Because it's gapping up. Was it a little bit novice? A little bit. Okay, so I just want to go over that real briefly. I don't have that much time. Guys, I have to kind of, to end this, I don't know what happened there. Did somebody just shut my camera off? I think somebody just shut my camera off. But give me 1 second, guys, and then I'm going to get off, okay? Give me 1 second, and then I'm going to get off. All right? Okay, sorry about that, guys. Yeah, I'm getting the hook, Bob. I apologize. I wish I would have saved 5 minutes. I really do apologize, guys. Anyway, guys, Pristine has a preferred broker now, Lightspeed as well as Realtick Pro, Realtick Express. Take a picture of this, jot it down. I wish I had more time to discuss it. But you can get your seminars paid for with discounted commissions through Pristine. So if you trade, you can get those seminars paid for by using Lightspeed or using Realtick Pro, et cetera, and so forth. If you want more information on that, please contact Kurt, Amber, or Ray. Again, I apologize for the crunch. I was having plenty of time there, and I just kind of ran out of it at the end there. Herman, to answer your question, no, he hasn't been part of this company for 7 or 8 years now. It's been a very, very long time. Got the boot many, many years ago. So 8 years and no. Same, okay. All right. Okay, guys, again, I'm going to put my email in. I appreciate the time that you guys took out to spend it with us here today. Thank you very much, and I apologize to the next speaker that I went a few minutes over. So if you have any questions, please shoot me an email, or please shoot Kurt or Amber or Ray an email, and join us for a free trial in the trading room. All right, so take care, guys, and I'll see you guys next time.